All right, ladies and gentlemen, it's such a pleasure and a privilege to be sitting here with Mr. Uday Kotak. And so I'm going to also throw it open to the audience at some point to get some of their views, to get their perspectives also on the questions. But I just wanted to start off, if I could, by taking forward the point that you were making a short while earlier. We talk about India being a $35 trillion economy. Is it possible? Yes. Is it probable? Yes. Is it feasible? Certainly it is. But it's not going to just happen because we have a dream. It's good that we are dreaming that big, that we are anticipating that big, and it's fantastic that we believe it is possible. We've taken the first steps. But a lot more still needs to be done to get it to work. So if you could just talk to us a little bit about the roadmap. How do we get there?
Thank you, Vikram, and thank you all here at this AIMA event. If you do the mathematics first, the starting point is if we have to get to a 30 trillion economy, say by 2047, it means from now, over the next 24 years, we need to grow at 9% dollar. Not 9% real, 9% dollar. So 9% dollar compounded over the next 24 years takes you from your current level to a 30 trillion economy. And which, in my mind, depending on what you believe is the rupee dollar depreciation, whichever way you take it, it really means we need to grow at about, say, 7.5% to 8% per year in real terms, give or take. And I'm assuming 1 to 1.5% as a potential differential in currency. So I believe 7.5% to 8% real GDP growth, 9% dollar GDP growth over the next 24 years is certainly feasible. And while there are many pegs to it, there's a real sector peg, there is a softer aspects peg, there is a whole issue about climate change, sustainability, and various other issues, culture, everything else. I'll focus more on the financial sector. And if an economy has to reach a $30 trillion by 2047, what does it take for us, for a financial sector, an Indian financial sector, to support us getting there? And I would start with an example of what we need to be thinking about. Go back last 20 years. India was in full boom time before the global financial crisis. And it was felt that like there is no tomorrow. You know, I remember the famous January 2009 meetings as Davos, where India was really so exuberant. It was telling the United States, you guys have messed up, we are the greatest. So we have to be careful about exuberance. And the Americans said, hey, this is your day, don't get carried away.
India everywhere, Davos, those sessions that were organized.
So we have to, first lesson in this history, which I think we got to keep in mind, is let's not get carried away. It's a lot of hard work, which we'll have to do. The second aspect of this period is post global financial crisis, we saw a significant damage to the Indian financial sector in terms of very weak balance sheets of banks and financial institutions, which happened and which really dragged India for a period of nearly 10 years, between 2010 and 2020. And you saw many challenges, including some failures in the financial sector. And what happened post 2020 is that we did a very good job, both from a point of view of the regulator and the policy, to clean up our system, particularly in the last 4 or 5 years. And we have done, even through the COVID period, done an excellent job cleaning up the problems of our system. However, the scars of 2010 to 2020 are still fresh in the minds of practitioners and policymakers. What we have to be clear about is the road ahead. And in order for India's financial sector to support the real economy, we have to think about this as to give an analogy. We need more roads, we need more cars, there may be some accidents, but we need good traffic signals and the regulatory system. But we must grow and encourage more cars and more roads. If we take a view, oh, we don't want any accidents at all, then we run the risk of not having the growth which we need. So how do we get the financial sector, including all the practitioners, to a mindset where we go towards a better regulated system, but don't become so conservative and cautious because of the scars of the past. Therefore, let us keep in mind zero accident policy is also dangerous. If you're wanting to grow and grow fast, there will be need for good regulation. We may have some accidents, but it's also how fast we respond and correct the accidents. I mean, go back to the classic situation in the United States of America. 1 year ago, people were talking, oh, American system is falling apart, Silicon Valley Bank has gone. But look at the speed with which they corrected the systems. So speed of response of correction is also as important. And in the last 10 years, it also showed us it takes a long time to get it back to where we want to. So how do we increase speed? How do we get better traffic lights? How do we get good regulation? But grow the cars, grow the roads, and make it happen.
So just one point on the accidents that you're talking about. The accidents could be people sanctioning loans that are not giving back. Sometimes bad actors will get it and siphon the money off. Sometimes it could be individual financial institutions overextend themselves and end up with NPAs that can't be done. Those are the accidents that you're talking
about. Things like that. And we need a very fast corrective mechanism. I think IBC is a great concept and moving the power to the creditor. But the issue with IBC is just takes too long. How do you have an insolvency and bankruptcy code which takes years for resolution? So very good concept, good law, but devil is in the detail, devil is in execution. Therefore, speed of resolution, should a problem happen, is a part of it. Because we at times are not able to manage the speed of resolution, we try and stop a situation where no accidents should happen in the first place. I think the two are very different in terms of how we look at it.
I mean, speed of resolution and the speed of way things work in the entire judicial system is probably the #1 challenge, and maybe we can come back to that a little later. But when it comes to the financial sector, just looking at the health of the sector today, I mean, obviously it's much better than what it was a few years ago. How healthy is it? I mean, NPAs look much better.
I think certainly better. And I want to move forward to say that another major transformation is underway in the Indian financial sector. And I call it as a transformation of a nation of savers is becoming a nation of investors. So you're seeing the whole intermediation process significantly and steadily move away from a traditional model, which was the saver-borrower model, to an investor-issuer model. This is great because principally the investor-issuer model has much lower intermediation cost. The saver-borrower model has a much higher intermediation cost compared to the investor-issuer model. But the investor-issuer model comes with its own challenges. It requires dramatically higher levels of transparency. It requires very close integration of a policy-making system across different verticals because a saver is not regulated. If you're a saver today and decide to invest tomorrow, your regulator doesn't change. You change your mind and you change where you play. The system, on the other hand, there is one thing which sort of monitors the savers, another regulatory system which monitors investors, and then there is the fiscal and the tax part, which is again with the government. The three need to work together if we are really going to make the investor-issuer model take off. And if it takes off, which I think the signs are very good, we could really have a phenomenal ability to finance India's growing needs. However, I must caution, there is only one country in the world which has got the investor-issuer model, and that is the United States of America. No other country in the world has really been able to make the investor-issuer model work. But India can. That's our opportunity. And we really need to see the risks to moving to that model as well. The risks are many. I'll just give one risk. If you don't handle it well, you could see significant bubbles happen. And I'll give the example, and let me be clear, India is not there. But I'm giving an example of what are the risks. You look at Japan between 1980 and 1989. You saw one of the biggest bubbles in history created in Japan in the equity markets. And the Nikkei index in 1989 was higher than what Nikkei is 35 years later, because they could not manage the investor-issuer model well. Same thing with China. The Chinese economy has grown for the last 20 years. Returns on capital markets are 2%. So you have to have real sophistication, efficiency, and proper guardrails, and understanding the nuances of what markets make the markets work. And normally, countries and systems find it difficult to manage.
So is there a certain maturity and a certain education that's now come to Indian savers? What you're saying about saving moving to investment, there used to be a time that if you want to save money, you buy gold, maybe buy property, put money underneath your mattress, God forbid. Those are the sort of things that used to happen. But now, if you look at what's holding up the Indian stock market, it's not FII money, it's the SIP. Every month, 15,000, 18,000, 20,000 crore rupees coming in as SIP investments. Have the Indian consumers matured to that extent, or is there still a long way to go?
I think Indian savers have tasted the pleasures of equity investing. And part of it is also because of a fundamental fiscal system which has very high incentives in favor of equity versus debt. And we have to be careful here. You cannot have a one-legged system. For a true development of India's financial sector to meet our aspiration, it has to be a two-legged system. It has to be equity and debt. Today, we are having a situation where we've got great incentives in favor of equity, but debt is become much more difficult to raise. Corporate India needs a combination of both. Therefore, how you manage incentives between equity and debt to ensure a balanced ability to play capital markets. And let's also be clear, debt instruments and fixed income bonds are also investor-issuer instruments versus deposits, which are saver-borrower instruments. So it's a very high nuance which is required. And we have also got to be careful in the point which you made about SIPs. I think it's great that the Indian retail investor has tasted blood. And you just need to see the results of last 1 year. And I'm going to highlight the dangers in that. A small cap fund gives you returns of 55%. A mid cap fund gives you returns of 40%. A large cap fund gives you returns of 15%. So where do you put your money? Where you get your returns more, which is in small and mid caps. However, there lies the ability of the system to ensure we get the right governance, where there is no excessive exuberance. You don't have stocks with P ratios of 60, 80, 100 just because too much money is going into stocks. There's an aspect about liquidity in the stocks. It is very easy to push up stock prices of relatively illiquid stocks, and some of them have really gone up. So investor-issuer model needs a great amount of sophistication and calibration, and which is why not many countries get there.
Right, let's if you come back to the health of the overall financial system and the lending that is taking place, a lot of what's been driving the economy in recent times, there's been a fair amount of government-led capital goods spending, spending on infrastructure, spending on roads and the rest of it. Animal spirits in the private sector are starting to be unleashed, and hopefully if fiscal deficit comes down, interest rates moderate, private sector investment will also be crowded in. There were excesses in the financial system which led to that entire boom, which then led to a crash and a slide which we're now recovering from. What are you saying about the nature of lending that's happening? How much openness is that? Are the systems more robust now that people won't be able to game it and take 5,000 crores and head off to the Bahamas, as it were?
First of all, I think we are in a very good place. I think we've got the balance sheets of financial institutions have been dramatically cleaned up. And I would say most financial institutions in India are a clean white shirt. And this is after a long time of more than 10 or 12 years. So I think we are in a very good spot. And this is a place, and I have to give a lot of credit to our regulators and policymakers. That is RBI, SEBI, ADA, Ministry of Corporate Affairs and the Finance Ministry for managing the Indian economy wonderfully, especially in the post-COVID period. We were all very concerned when COVID first hit us. The way we have managed our economy from a macro point of view, even from a point of view of, the government of India needs to be complimented even on geopolitics. How have we managed beautifully the Russia-Ukraine situation? India is right at the center stage in the world. The world gets comfort in India when the Chinese economy is going through its throes. This is a time when we really have an opportunity. A strong financial sector is significantly lower current account deficit, fiscal deficit gradually opening. I think the stars are aligned. And I just hope that we get our act together and look at this as a marathon run and not be carried away for wanting a sprint. And the last time we really went for a sprint was 2005 to 2008. We should avoid that this time.
Right. When you talk to people in the government also, and you say what's accounting for some of this technology, they keep talking about technology, the formalization that we are seeing, the fact that digital payments have gone up, the fact that, for example, tax collections are buoyant because so much information is available, it can't be leaked. Are you seeing technology playing a role in this?
Technology is a very major part. I think there are three aspects to finance going forward. First is customer. The customer of today is in the world of Google, Meta, Apple, Amazon. The kind of experience the customer is getting in that versus what that customer gets from banks and financial institutions, there is a gap. And it is incumbent on all banks and financial institutions to wake up and shake up. Because or you are going to lose customers, and they have, each of the banks and financial institutions should be thinking that if tomorrow Google is allowed a bank, what will happen to all? And we really need to get the customer act first at the cutting edge for the kind of experience the customer is getting on other platforms. So that is point number one. Point number two is there has been a debate for quite some time in the financial services industry that what takes precedence, technology or risk management. I believe the financial institutions of the future will be customer-centric, high-quality risk management companies powered by technology. What you have to be careful is, at times, pure technology companies have a habit of being fast and loose on regulation. So we have to be clear that the base and risk management includes many things. It includes credit risk, operational risk, reputational risk, a whole host of things, regulatory risk. Therefore, you need the future of financial services is customer-oriented risk management companies powered by technology.
On the point which you were just making about the customer experience still needing to evolve, if you actually talk to people from abroad who sometimes come out here, they are in fact quite positively surprised. I've had friends and family who come from the United States, for example. You show them what you can do with UPI, you can show them what you can do with online banking in India. It's actually way beyond what they can experience, even in a country like the United States.
Yeah, but I think your future competition is not how good or bad banks are in the US or Europe or UK. Your competition is the Google, Meta, Apple, Amazon. And that's your benchmark for the future of the customer experience.
Right. There will be, of course, other things that will come up. The entire question of digital currencies, how will it work? There are some people who believed that the competition was going to be, crypto, for example, and there are questions of regulation around that. How do you see India playing in that space?
I think India's position is clear. India does not like crypto.
Thank God for that.
Having said that, if you just have, you got to look at the crypto market in the US. I remember it went down to some 18,000, but the last I saw yesterday, it was up to 51,000 again, the Bitcoin. So something is still holding it. And I think in what you got to keep in mind that for all the negatives of crypto, and I'm not a believer in crypto myself because I don't understand it and what purpose it serves. But you got to ask the
What's worse is if you ask people who do understand it, they still don't have a logical answer.
That's correct.
As to why it should be priced at what it is.
But it's like gold. Why do you buy gold?
You've been buying gold for 5,000 years.
No, but time doesn't give you the logic. Okay, it's just the habit of the mind that we say gold is a store of value, but it's a piece of metal. Why is gold having value? So there is something which is different about gold, and crypto really is an answer. If you talk to the crypto supporters, they will say that basically central banks around the world have debased their currencies. They've been given an ability to keep on printing money, and you just print more currency, it suddenly becomes value. So against that, whatever the positive arguments on crypto are, that you can't keep on creating new crypto. Therefore, there's a limited finite supply. And that is the argument against which I think bottom line is irresponsible central banking, particularly in developed markets, is the biggest risk for alternative assets to get more importance.
So do you think something like CDMC is going to really catch on, or again, will that come back to the same point that as long as the government is issuing it, they can always debase the currency?
I think central bank digital currency has tremendous legs. It has to get customer utilization. It can be a very big positive, but it will dramatically change how financial institutions will work in the future. It will still not get away from the fact that you will need an intermediate for risk management, which is the heart of what financial services is and will always remain.
All right. Before I start throwing it open to get some comments from the audience, I just want to come back to what I began by saying, the roadmap ahead at a broader level. A lot of things India has done correctly. The focus on infrastructure, for example, is really great. Digital and physical infrastructure is being done. A lot of the things that we would gripe about way back 10 years ago is not really problem areas right now. What, to your mind, are the major issues that need to be fixed right now? Is it what you were saying a short while back, the time? I mean, the fact that judicial delays are so much that things can just get locked up in cases forever.
I think capacity building in the financial sector, seriously pursuing a balanced model both for savers and investors, a very significant macroeconomic management between fiscal and current account. India boldly aspiring that over the next 10 or 15 years, is there a sliver or a window where the Indian currency has a chance to at least begin the steps towards the reserve currency?
I was going to ask you about that actually. There is this talk about de-dollarization obviously that is going on. I'm not sure how many legs it has right now because it's not clear what the alternative is. I don't see the rest of the world accepting the yuan, for example. Is the dollar under risk, and at what point does India say we need to move towards capital account convertibility?
See, finally, my view is if you keep on printing money, and then you must see the interview of Vladimir Putin recently, where he said that the biggest mistake, and this is his view, not my view, the biggest mistake the United States has made is sanction the reserves of Russia. It has forced us to look at alternative currencies and alternative mechanisms for our trade, and over time it will put fear in more and more central banks to find ways around versus keeping all the reserves in nostro in US dollars. Therefore, India has the opportunity. I can't think about keeping my money in a Chinese central bank, and there are not too many places in the world which I can. Therefore, can India reach an institutional framework with a macroeconomic stability where the world can trust India for keeping their money safely?
But the first step to that obviously has to be to start letting the currency float, to have capital account convertibility, to at least have steps towards that. If you're still controlling it, and you've got LRS, and you've got all those other restrictions on sending the money, how do you become a reserve?
But 24 years are a long time.
What would be the immediate? In fact, I was about to ask you that. How do you break it into?
I think it has to be to get bolder. Again, I'm a believer that the best way to start experimenting is by doing it in a small pocket in the country. I do believe Gift City has potential. You should be thinking about opening windows out of Gift City and test and experiment on some of the balloons and see how it goes in the direction of more open currency, both trade and investment. And based on that experience, gradually make it easier for Indians to move currency in and out. And I think if we can get there, and we manage our current account and fiscal deficit over time, and truly institutionalize our processes where people can trust the institutions of India. That's the foundation for building a long-term step for a reserve currency. And reserve currencies takes at least 100 years. And you just go back and think about the early 20th century. People used to say, the sun never sets on the British Empire. I heard a friend of mine from London say, I'm trying to figure out when does the sun rise in the British Empire.